feel about the direction of travel and the impacts that these tariff negotiations are going to have on your investments, on the economy?
Obviously, there's a lot of unknowns here, so it's difficult to answer that question because we don't really have the parameters yet for what these tariffs will look like in aggregate or country by country. And as you've been hearing, I think, from a lot of the business community that's been on the show, that's what people are really looking for, is the certainty and the parameters, and then they can organize their business around those parameters. I just want to make one broader point that I've also heard people express some confusion over, which is that the catalyst for the tariffs is somehow the U.S. was losing in some capacity. And I just want to put out there for you that the United States is 5% of the world's population. We're 25% of GDP, and we're 70% of world equity market capitalization. So some people might argue, actually, we've been doing a lot of winning, and the place that we came into this year ahead of these policies, we were in such a formidable place and had a lot to lose. And I think that's what the market reaction was showing us after these were immediately announced, that there's potential downside pressure here.
It's kind of interesting, though, because we talk about those market moves. To a certain extent, they've snapped back, certainly in the equity markets. I'm not quite sure if they've snapped back completely when it comes to credit spreads.
Yeah.
Are you seeing maybe a tinge of more confidence today in that place than where we were 4 weeks ago?
The markets have come back. We think it's not fully justified. We expect more buying opportunities ahead. And to just wind back the clock a little bit, we all talked at the beginning of the year. At the beginning of the year, this community, which is quite negative at the moment, was very positive at the beginning of the year, if we remember that, because we said, okay, rates are going to come down. We've got animal spirits coming. There's going to be deregulation, tax cuts. People were so excited about the future. We were underweight credit, both in public as well as private markets, not because we're geniuses. We didn't foresee this trade war being as severe as it was. We just looked at that situation and said, even if it is as good as that, this is already fully priced into markets. It led us to be underweight. Then the year has played out the way it did, and we got the opportunity to step up and get involved. And actually, a few weeks ago, we had the largest trading day in the history of TCW, which has been around for 50 years, because we had this dry powder to step up and provide liquidity when other people couldn't or wouldn't. Now, since that moment, obviously, we've had a retracement, and you're asking, do we expect it to deteriorate? Yes, we think the market's going to give us more buying opportunity.
How big have the buying opportunities been, and how big will they be? How much are you willing to put to work?
Well, when we just separating public from private, we'll stick with fixed income markets. In our public fixed income portfolios that are multi-sector, we entered the year at a maximum underweight credit, which was 15%. We've already eaten away at some of that, and you actually, in some ways, we could just buy into the credit market because everything had sold off indiscriminately. We still have plenty of money to put to work in the public market. We can buy selective opportunities, so obviously looking for companies that are protected from economic weakness, that aren't as exposed to tariffs, and selectively you can find some of those credits. And then we think in aggregate, the uncertainty will continue, the volatility will come back, and we expect to be able to close that underweight more. In the private credit markets, we also came in with a lot of dry powder. Our biggest opportunity set continues to be in rescue, which we spoke about at your private credit conference. We're continuing to see a phenomenal pipeline of opportunity there, companies that really need this flexible financing. And obviously, the tariff news, the fears of them, or the reality of these tariffs, as well as broader pockets of economic weakness, has brought more of those companies to the table.
But with regards to the volatility out there writ large, we may not get a reprieve from the White House anytime soon. I mean, obviously, they have the power to tamp this down. I have to ask you, given that the Fed is starting a two-day meeting, is there any chance we might get maybe a reprieve from the Fed, not necessarily through rate cuts themselves, but more so the communication about what level of support they are willing to provide?
First, I'll talk about rate cuts. I want to say the reprieve that we need right now is clarity. That's what companies want. We have some of the best companies in the world, obviously in America. They can do hard things, but they need to know what the parameters are in which they're working. I also just want to make a comment here in terms of vulnerability, and I will come back to rates. When you think think about how companies navigate this environment, the larger companies are actually much better positioned to navigate this because they can move supply chains around and they can access more quickly and at better rates flexible forms of financing. So smaller companies are going to be the most exposed, and this is connected to rates. Let's remember those are the companies that employ the most Americans. Okay, now let's pivot and talk about the Fed. They're in a very difficult situation. They were, I'm sure, I haven't spoken to him personally about this, but Chairman Powell was very excited for the soft landing that he expected to come in 25, and that dream has evaporated a little bit. So now what is he facing? He's looking at a situation where the economy could be getting weaker. We personally think it was weaker than people appreciated coming into the year, but there are some weaker data points around that. And we have a situation where he's told us he thinks these tariffs are going to be inflationary, even he just doesn't know for how long, and he's going to wait for the data. So you are right, we're going to hold. That's what consensus thinks. We agree with that for right now. Now we have three paths from here. Path one, we sort out all the tariff situation, we get the tax cuts going, we deregulate, blue skies, everything's great, soft landing, maybe.
That's the ideal scenario.
That's the ideal scenario, the one I know that they hope for. Scenario two, we get into a recession because actually they're behind the curve and growth is slower and these tariffs are more punitive than people are currently giving them credit for. That's a regular way business cycle. We all know how to work our way out of that. That will be fine in the end and present some opportunities in the interim. And then the third scenario is stagflation, and that's obviously tougher to navigate.
What's the most likely scenario?
We are preparing most for the middle scenario, either a weaker economic environment or a recession that's not catastrophic, just a normal business cycle. We haven't had a business cycle in a long time, so people get very hyped up around that. But we know as a country how to tackle a business cycle. That's what I would say we're preparing the most for, as evidenced by the fact that we're retaining a lot of dry powder. It may or may not happen. The one thing we're highly convicted about is the volatility is going to come back. The opportunities are going to come back, and these dislocations and volatility, that's the rocket fuel for the business we're in, active management.